Take a look at the futures this morning. We are seeing a mixed picture. I think the S&P might be down, NASDAQ down a little. Actually, now the Dow is also down, so we're down across the board. Joining us now, Mimi Duff, GenTrust's Managing Director. Mimi, it's good to see you. What were your? We haven't had you on since Wednesday. What did you think? And what was behind that? Have you ever recalibrated anything? I don't. I'm going to start using that word.
That's the key message. It's a recalibration. I think the most interesting bits of the Fed meeting were that they are taking a level-based approach. They think that 5.5% is the wrong target rate for this economy. Lowered it pretty aggressively to 4.75 to 5. So they're not going to wait for material weakness. They are basically trying to calibrate the funds rate to the current economic conditions. So that was one bit. And the next thing for me, the most interesting, I think, was the amount of disagreement on where the long-term Fed funds rate is. So they edged that up to 2.9%. But if you look at the variability in the dots on that dot plot, there's a lot of variability. See that last column there? And that's affecting the whole path along the way.
Mimi, I just think in the past, I guess maybe it was Greenspan or just the experience with Volcker, the risks weren't ever really seen to be balanced. Like the economy, I think the Fed, people thought, had less to do with being the engine for the U.S. economy in terms of jobs. And the Fed was more there to guard the sanctity of the dollar and to keep, the most insidious force known to man is probably inflation. But I guess after the Japan experience and other things, no inflation can be bad too. And it almost looks like this Fed, it's almost equally concerned with each mandate, which is, I think, recalibrating. Because I just don't understand it, you build up this dry powder to use for the next slowdown. With where unemployment is right now, it doesn't seem like the jobs picture is as important as keeping inflation at bay after what we just went through. They seem to think that seems to be on the back burner now, inflation. And they're full on with pedal to the metal for job growth, which is already at historic levels, the employment.
Yeah, I'm not disagreeing with you there. Look, I mean, on the inflation, the Fed does have a dual mandate. Most central banks have the single mandate, the inflation target. Again, I go back to that long-term dot, the long-term neutral. Nobody thinks it's 2%. That's interesting to me. On the degree of recovery that they've seen so far on the inflation picture, if you're looking at the monthly prints, they really do look good. So I think that given the deterioration, the recent deterioration in the job side, they are pivoting. I don't disagree. They are definitely taking their dual mandate seriously here.
And you, as an economist, you think that I would go 2/3 dollar stability and 1/3 labor. I don't think the Fed should be concerned. The U.S. economy can take care of itself in terms of job creation and innovation and everything else. Just give me a stable dollar and stable prices, and everything else takes care of itself. Do you agree with a 50-50? Or right now it looks like 75 labor, 25 inflation.
Well, I think listen, I mean, they have a dual mandate. They're not GDP targeters.
It's a stock market, Mimi. That's what I'm getting at. I think they like stock markets that go up, too.
They'll never say that. We know that. But the stock market yesterday, there was a lot of exuberance, a little delayed reaction there.
We're at all-time highs, and we're cutting interest rates like the world's ending.
Again, they're coming to this level argument, right?
So we're recalibrating.
Yeah, they're recalibrating.